Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So recently I've been getting loads of emails regarding looking at individual stocks that you guys are interested. So I've now got about I think 10 to 12 different stocks that you guys have asked me to analyze. So I'm going to try to do as many as I possibly can in the next few days, and right now this is the first one because there's about 5 of you that have asked me to look at this company over the last few weeks. So what I'm going to do is I'm going to give you everything you need to know about this individual stock. I'm going to look at the company information, the fundamentals of the business, compare it with the S&P 500. We'll look at the valuation, and then I'll tell you my plan basically of what I would do with this company. I don't actually own this one. I've come across the company about 3-4 years ago, and it's been sort of under my radar here and there because it's one of the companies. I own 2 other companies that are very similar sort of a business. They're not in the same industry, but they are kind of similar in terms of collecting data from consumers, and they've got so much data. They're turning all of that data into AI, using AI. So that's it's been under my radar for quite some time, but it's always been seemed overvalued. But lately, it's down quite a bit. So what I'm going to do is I'm going to give you everything you need to know. And the company we're talking about today is this company here. Okay, Equifax. Equifax is one of the world's largest consumer credit reporting agencies. They are similar to Experian, which is basically in the UK, TransUnion, and it operates globally, providing data, analytics, and technology services. Its offerings include consumer credit and demographic data, analytics, identity fraud, and monitoring systems, primarily aimed at businesses such as financial institutions, retailers, insurance, government agencies, healthcare providers. So they work with a lot of different companies, which is very interesting. Before we go more into the video, please, if you can join us in the Patreon account, that would be absolutely amazing. It genuinely helps the channel. If you can't do that, just like the video, subscribe to the channel. Right, so that is just to kind of give you an overview of what the company does. Just a couple of more things just to kind of give you like the revenue breakdown, basically how this company makes money. So they got like 3 main sections. They've got workforce solutions, which basically in 2024 made about $2.4 billion, which includes the work number, employment, payrolls, data services, and it was up year over year about 5%. The next one is US Information Solutions, which it was about $1.9 billion, and that covers things like consumer credit data, utilities exchange, telecom, and it was up basically about 10% year over year. And basically so a lot of that came from the fact that they've got cloud and they got basically AI innovation. This company has so much data they now using. Remember, data is these days the most important thing. The more data you have, the more you can analyze the data and do a lot of things with it, especially with the AI these days. And then they've got the international segment, which is basically $1.35 billion revenue from operations outside the US. Was nearly up about 19% basically with constant currency and so on. So three different interesting segments within their business. And as you can see here, year to date is down about 3%, 6%, 60 months for the last 6 months, it was down, but flat almost. For the 1 year, almost basic 6% down, and for the last 5 days is about almost 3% up. So now what we're going to do is look at the financials. So you have an idea of what the company does. Now let's look at the financials. So that's the first bit that we're going to look at. And I'm going to use this website, but let's look at the financial sections of this business. We're looking for the EPS as well as, of course, the revenue. So you can see here earnings per share. It's been up and down, so it's quite cyclical business, if you like. And of course, it depending on how the economy is doing, maybe that's why it's basically very cyclical business. And when it comes to the sales growth, on the other hand, was been steady. It's been from $2.6 billion to right now $5.8 billion. So it's been growing consistently over the last years, even including COVID time. It basically grew it. So which is very interesting. With regards to in terms of profitability side of things, return on equity about 13%. Return on invested capital about 8%, operating margins of 19%, which is very good. Free cash flow margin about 16%, which is really nice. Debt levels is also quite low. So that side of things is really good. The other thing I want to check is dividend side of things, because this is dividend paying company and we want to see how that is looking right now. And as you can see, it's about 30 billion market cap, 0.8 in terms of dividend yield, which is quite low. But I think this is the type of business that you would actually buy, not for the dividends. You will buy it for the dividend growth as well as the price appreciation. In terms of dividend safety, 82%. The highest you can get is 99%. Anything above 61 is really good. Credit rating, we've got BBB, moderately strong, which is nice. Now, if we look at the payout ratio, so this is how much of their net income they use to pay out, that dividends, if you like. So that 22% is very good, because that means they've got room to improve if they need to, or increase if they need to. 28% in terms of the latest increase, that was April 2025. Last 5 years, they have not been paying it for that long for that reason. So let's see what they do in the next couple of years. As you can see here, they've basically, from 2020 2010, they basically, when did they start? 2015, 2014, since 2005, sorry. Since then, they've been increasing a little bit, then it jumped massively, and then as you can see, it's been going, but it's been flat for the last 6 years, well, last 9 years, if you like. So it's been flat for quite some time. Yeah, so you get $2 for every share of this company that you own, and it seems undervalued based on the this line here. So when that dotted line is slightly below this blue line here, that means the stock could potentially be slightly cheaper. Now, the other thing we're going to look at now is two things I want to normally check is the finance. If you go to financials, we'll click balance sheet, and we want to see the current assets and current liabilities. So we've got about $1.5 billion when it comes to the current assets. That's stuff they have right now. In the next 12 months, they can liquidate that to actually pay any outstanding debt or anything that basically comes their way. So sort of an emergency, if you like. Current liabilities, we're looking at about 1.9. So that's interesting. So 1.9 is what they have to pay in the next 12 months. If basically and things go south completely, they will have to use this 1.5. So they've got less than that. But one thing, then we need to look at the free cash flow of this company. And I think the free cash flow, we can just get it from here, because I was just checking it. This is their financial report, the quarterly. I think this was on the 27th or 22nd, whatever it was, of July they've reported. And this is what they reported. So as you can see here, we've got about 900 million plus. So that is covered if we need to. The 1.5 plus that 900 million should be able to cover that current liabilities, which is interesting. This is another thing I liked about this company when it comes to they're focusing more on growing their basically free cash flow, which is nice. So as you can see from where it was in 2013 to 2014, 2015, 2025, sorry, and let's see what it basically happens in the next couple of quarters. But it is interesting. It's really nice to see that the fact that they are buying back their own shares. So they've started buying back their own shares, interestingly. So that's 127 million basically in this quarter, which is very good. And dividends, basically they've now paying basically $0.50 for every quarter, which is what we saw, those $2 that we saw earlier. So yeah, free cash flow is growing, which is fine. Debt levels is not bad at all. I mean, the current liabilities does not cover current liabilities is not covered completely, but total liabilities is $6.6 billion against total assets, which is 11. So that covers massive, basically everything. So which is absolutely fine. So financial side of things are good. Revenue looks like it is heading the right direction, like we said earlier. Okay. And yeah, looking at this, basically $5.8 billion of revenue last trailing 12 months, only spending 2.5, which is very good. 3.3 gross profit, and then the net income is about 600 something, which is basically also seems is growing and heading in the right direction. So yeah, it's a very decent company from financial side of things. It looks like it's growing. The other thing I want to check now is the expectations moving forward. So now we know it's a very good business. We have an idea what the business does. The other thing we need to look at is the expectations moving forward. And 2025 is not a great year for this company. It's almost finished anyway. But 2026 is where they think basically things will come back. And as you can see, you got almost a 21% growth for in terms of year-over-year growth when it comes to revenue. That is a massive growth. And when you look at the 2027, it's about 24%, then 19% or 20% in 2028. Now, if we just focus for the first three, because that's when a lot of analysts are looking at, these two maybe not so much. When it comes to revenue, we're looking about that 10%, 11% as well, which is very interesting. So really good overall, so far so good. Quick thing I'm going to look at is the valuations. This is where it is at now, and this is the 5-year average, so it's slightly higher than where it was the last 5 years. But the sector medium is basically, we're looking about 21, so it's very expensive in comparison to the other companies in the same sector as well. And you can pause the video and have a look at things like price to sales, price in EV to sales, and all of these things, and PEG ratios. PEG ratio above 1.75. Normally we say anything above 1.5 is okay, especially for high growth companies. We like to use that. So now what I'm going to do is using we're going to look at a Morningstar and also tip rank and Refinitiv and see what they say. So this one says it's about 13% upside from where we are. $281 per share is where they think the price should be. Tip rank, let's have a look at what they say. So it's a strong buy. That's very interesting. So tip rank, what they do is basically they take the average from all of these analysts basically, and there are about 13 buys, 3 holds, and no sales whatsoever. $285 per share is where they think the price should be. Right now, 247. So this is before market opens. 15% upside from where we are, which is interesting, and they are saying it's a strong buy. If we go back here and check the same thing in the ratings, more or less it is heading towards that strong buy if you like, but we got 10 strong buys, 5 buys, and 8 holds, and no sales whatsoever. 13% upside from where we are. 280, and also this one is almost basically similar to 285, so not bad at all. If we look at Morningstar valuation, it's 3 stars right now. It has a wide moat, as you can see. $270 per share is where they think the price should be, so it's slightly lower. You can pause the video and have a look at what the bulls are saying, what the bears are saying, and so on. But yeah, so far interesting. The final thing is to check fast graph and see what this company but fast graph thinks about this company. Now if we check one thing, and that's basically the forecast quickly, if we use the current estimate, okay, of the stock if you like, and the fair value for this company is 143, which is where it is now, okay. Future stock price, okay, so this is basically that negative if you like growth side of it is there, the estimate return, so you will not be making basically enough money. But 200 and what does it say here, future stock price, which is $218 per share, which is quite interesting, right? I think it's probably the dividends that's helping. So but if we use the last 5 years, I'll show you the graph in a second. The growth, of course, it stays the same, the growth rate if you like, but estimated annually rate of return goes basically, it's about 17%. With this one, you'll be losing about 4% of your money if you like. With this one, is you're making about 17%. So 230, the fair values for the stock price is be $233 per share, and future stock price of $354. That's very, very bullish, okay. But they're using this 20 and 24 growth expectations for 2026 and 2027, and there's about 23 analysts looking at this one. There's about 17 analysts looking at this one. So if we could just quickly show you what we normally use anyway. So this is basically that 19. It's more or less the same, exactly what I've shown you earlier. That's 4% there. And if we use the normal multiple, which is we've already seen, that you may be making about that 17%, so 14,500. So overall, I like the business model. I like the fact that it's, like I said, is very similar to, it kind of reminds me of S&P Global. It kind of reminds me of MSCI sort of vibes. But the issue with this one is right now I don't think it is cheap enough, in my opinion. Okay, if I could potentially get company that's expected to grow this much, okay, 20 something, but look at the current blended PE of 33. To me, that's a little bit on the high end. If that was below 20, I would have actually maybe interested. But again, for the last 5 years, if you look at the last 5 years, the company has been on that 30 something. So I don't know. Genuinely, right now, this is not attractive to me yet. Maybe if it comes back down and again another 10-15% is something that I would be looking into. Now, the reason we're doing this video is because some of you requested it, so that means you'll probably be interested. I would be honest and just say be mindful and make sure you have at least a 10% margin of safety. That means if the stock price is $270 per share, take out basically another 10%, 15% for your own safety, and then just add it to your watch list and wait it to actually hit that price. That price might be now. So I would definitely say if it comes back down and maybe another 10-15%, because remember, when you're doing individual stocks, it's very difficult to time the market sort of. So if you by adding it to your watch list to do what you need to do, you probably will get that opportunity. Because if you think about it, year to date the stock is down about 2-3%, so it hasn't actually moved much, to be honest with you. So if it goes below, look, 190 about $200 per share was basically the 52-week low, so it could potentially hit that if something happens. So yeah, for me, it's not a buy right now. I would need a little bit more margin of safety to buy this stock, but overall it's a very interesting business and potentially one you can add to your watch list and just sit back and watch it and let see what happens. Maybe in September, if we get massive pullback and this company goes down at least 10-15%, then maybe I will be attracted to the company. I like the fact that they pay dividends. It's a solid dividend. It's not the best, the yield is not the best, but when it comes to the consistency, is not there as well. But the current, what they're paying and the fact that they're going to grow that hopefully in the next whatever years, that seems interesting to me. Anyway, I'm going to stop the video here. I hope you're having a great day. If you haven't joined us at the Patreon account, please do so. It genuinely helps the channel. Anyway, let me stop here. Have a wonderful day. Assalamu Alaikum.